Joe Consorti on the Blue Collar Bitcoin podcast. Last minute, Josh is headed to Mexico on a vacation. We felt like we were a little macro thin with all of the unfolding shit show globally. So we pulled Joe here out of the bullpen last minute, and we're asking you to basically close this game out perfectly. And it's been wonderful pre-recording, too. We've talked about cocaine. We've talked about Joe nipping out. He's actually, speaking of casual, Josh, like he took blue collar really literally because he went with his fucking workout shirt where I'm almost seeing that's left nipple, right? Or is that right nipple? Is it reversed?
That's almost like you guys seen the South Park episode where the cable guy has a shirt that has two little pouches that rip off so people can see his nipples.
Yes.
And he rubs his nipples and tells people, try and cancel cable. Try.
Mm-hmm. Dear Lord. For anyone still listening after that, kudos to you.
Yeah, well, they're kind of used to it.
They're
at this
engaged
point.
now.
I love it.
Yeah, I've got my I've got some big brain macro lubrication juice out here. It's a Orange Door IPA out of Evanston, Illinois. Shout out to Sketchbook Brewing.
It's definitely too late for cocaine.
Yes, Stimmy's in the morning, and then when the nighttime comes, it's time to get that blood alcohol content up.
Here's the problem though, Josh, because I see you're drinking as well. When we have these macro discussions, we love macros. Kind of our, even though we can't claim to be experts, we love these conversations, and we've been deeply interested in them for a decade or more. They are at the peak, if you will. They stretch us in terms of our ability to hang and keep up. And alcohol doesn't help my brain work, although it makes conversations more fun. So you may have to do some heavy lifting here, Joe.
Yeah, for sure. Yeah. No worry. It's all about the viewer experience, right? And so I suppose the hosts of the podcast inebriating themselves, it brings the bar lower for the listening experience. And so now I'm forced to explain it even simpler, which is good because I need to work on that too. I found that explaining things simply is something I definitely need to work on. So this is going to be an exercise in that.
Explaining complicated shit simply is one of the most difficult things you can do. And it's really an exercise in how well do you really understand it, you know? Are you going to baffle people with bullshit, or can you make it dumbed down enough for a regular idiot to understand and comprehend?
That's right.
And that's what we're going to find out today, Joe. Can you do that?
Yeah, indeed. Yeah. And fourth quarter, definitely last minute late replacement, but hey, coming off the bench, and I got to give it my all if coach is going to give me any more playing time.
I believe in you. First of all, before we get into the meat and potatoes here, who are you? Introduce yourself to the audience, and then we'll get into the good stuff.
Absolutely, yes. So my name is Joe Consorti. I'm a recent graduate from the University of Vermont, Grossman School of Business. I don't know why I named the business school, but up there I studied general business administration with a concentration in finance and then economics. So I got 2 degrees. And I got the economics degree by accident. I took so many econ classes that I inadvertently got it. But either way, I ran, through college. I came to discover Bitcoin after we got sent home from COVID. It was like October of that year, and I'd become pretty jaded towards like the man because I got sent home during spring break during 2020, and I wasn't allowed to get my stuff. So for spring break, I packed an overnight bag because, it's spring break, and I wasn't allowed to go back and get my computer or anything or any of my clothes. We weren't let back into the dorms. So I was pretty jaded. And then towards authority in general, and then my friend Tyler LaRoche, who works at Bitcoin Magazine, sent me 2 articles, The Masters and Slaves of Money by Breedlove and The Bullish Case for Bitcoin by VJ. And I read both of those. I love them. I thought they were fantastic. And, at this point, basically before I got into what I'm doing now, which is this markets analyst position, I ran 2 businesses during college. Both of them were painting businesses. And so as I was learning more about Bitcoin and becoming more interested in that, of course, all throughout my college years, studying markets pretty not religiously, I suppose, but the next rung down, I guess, in terms of how ardent you are about markets. All the while I was doing that, I was researching Bitcoin. I was running these businesses, and I did this painting business for 2 summers. I did 6 figures the first summer, and then I did $250,000 the second summer. in revenue, not profit, definitely not profit. And I was profitable, but not to that tune. And it came down to, okay, I really love this Bitcoin thing. I believe this to be a solution to many of the woes in our current global economy and financial system. What am I going to do this next summer? I have the ability to either do another year, do another summer of this business, but do it even larger, right? And I figured that my time would be much better spent dropping that entirely, trying to graduate a year early, and then analyzing markets and making that my job. And so that's what I did. I graduated a year early. I graduated this last summer, and basically spent all my time for the first and second semester of my final school year, which was my junior/senior year, publishing my analysis on Twitter just independently in hopes of finding a job. And eventually it worked out. Nick Bhatia, whom I don't know if he's been on the show before. I know
he has.
He has.
Fantastic. Yeah, you guys interact a whole lot with Nick on Twitter. And he found me on LinkedIn via a mutual friend, Matt Snow. Nick was looking for a research associate to turn the Bitcoin layer, which is now this big neon sign behind me. It didn't used to be worthy of a big neon sign. It was just Nick's sort of every so often hobbyist markets publication into a genuine bona fide markets research provider. And the first step in doing that was to get an analyst on board, and right place, right time. I was the one that was referred to Nick, and here we are today. Now my job is to be in front of a computer screen and analyze markets, break them down simply.
Damn. A couple of things from that. You kind of identified one of the leading causes of jumping or falling into Bitcoin, which is intelligent, jaded disposition, and distrust for authority. I think those three characteristics cause people to fall down this rabbit hole a little quicker than others would otherwise. I'm curious, though, from your economy or economist degree, how much of that did you feel like you had to unlearn when you were kind of diving down the Bitcoin rabbit hole? Did a lot of this kind of was a lot of this hard or difficult to learn, or did you have a lot of weird situations where you're like, this doesn't make sense because they taught me something completely different in those classes? Or how did that all balance in your head as you learned?
Thankfully, it wasn't, because when it came to my econ degree, there are certain subjects that I learn, and I understand that the reason I'm learning this is for the class exclusively. It's conceptual. I'm not going to actually fold this into my markets framework. And thankfully, when it came to econ, like the way that it was taught in school and the way that most econ textbooks are structured, a lot of it is just conceptual, purely theoretical, like math. And because of that, like not a lot of the, that can be, I didn't fold a lot of it into my markets framework because of how sort of conceptual and like high level and theoretical it all was.
Right.
So I'd like to thank my teacher, I suppose, for approaching econ that way when I was initially being taught it. So thankfully, when it came to Bitcoin, I didn't have to unlearn a whole lot, right? You go into econ in college and you're learning, labor supply, labor demand. You're learning all about the Phillips curve. You're learning all about the Taylor rule and all these other things that sort of stick to your brain for a period, and then you lose them. Thankfully, because I certainly wasn't planning on becoming an economist, I just took the classes because the concepts were pretty easy to grasp. So thankfully, when it came to Bitcoin, and I came to learn about Austrian economics, then it sort of I didn't have to unlearn a whole lot, thankfully.
Okay, I guess the more direct question would have been, how much Keynesian theory did you get taught versus did you get any exposure to?
It was 100% Keynesian.
Okay.
Up at UVA, especially up at the University of Vermont. In communist China up there in Vermont, it was 100% Keynesian for sure.
The thing I love, Joe, about Bitcoin in general and the Bitcoin ethos is just how enormously meritocratic it is. Like, it does not care how old you are, how much experience you have. It cares about what your output is and how valid and well-researched your perspective is. We've been reading a lot of what you and Nick have been putting out, and it's impressive. And you are, I mean, the two of us are blown away that someone your age can have this good of a grasp. I guess, Josh, that's the advantage of having no kids and no commitments whatsoever, is you can literally just study econ all day, every day. And
apparently in excess of cocaine. I mean, that certainly contributes
Coke
as well.
and unlimited time. It's a potent combination.
That's right.
But you
That's
came
like
to mind.
two of the three pedestals that you need to live a healthy life.
Exactly.
Don't ask what the third is.
You know, as we alluded to, you came to mind immediately just because you are totally entrenched in this stuff. You're eat, breathing, and sleeping it. So to kick off our macro discussion here, I'm going to start out with what I think is a super sophisticated, refined, cultivated question about the global economy, which is, what in the fuck is going on, Joe?
That's a tremendous question, and an even better starting point, I would say, for our discussion. Well, there are several things going on. I guess I'll start like in the middle of last year, I suppose. In the middle of last year, we'll call it like June, July. We're heading, into Q3 and Q4. There was this general consensus, like all throughout last year, that, the Fed's done here, the Fed's done here, the Fed's done here. But there was really nothing to back up that notion of the Fed is done with QT, the Fed is done with hiking. That idea in markets was basically just markets getting out ahead of their skis and really hoping that the Fed would stop doing what they were doing, because this was really aggressive and it was going against the regime of 2012 or 2010 rather, all the way up through 2018 when the Fed was at zero interest rates and they were expanding the balance sheet, and then from 2020 all the way up through early 2022 when the Fed was at zero interest rates again and they were also expanding the balance sheet again. And that was, infinite bull market party time. The Fed has artificially slammed the cost of capital to zero. Businesses can borrow for nothing. You can refi your house for 2%. I know my dad was stoked about that. At the time, of course, I didn't care, right? I didn't pay for the house. Still not paying for the house, right? And this just tremendous misallocation of capital. It's just this huge party. And then the Fed takes away the punch bowl. And then the immediate knee-jerk reaction from everyone is the Fed's going to stop now. The Fed's going to stop now, right? The Fed usually raises their policy interest rates in 25 basis point increments, because that allows them to have more of a handle on policy, right? And just like, you can arrive at terminal either in 2 months or over the course of like 2 years, right? And that's the Fed chooses the latter usually when it conducts policy, because it doesn't want to really disrupt financial markets. But because of the pace of inflation and the fact that the Fed really doesn't have many other tools, right? It decided to hike not just in 50 basis point increments, which is already double the size it normally does, but 75 basis point increments, which is like totally unheard of. What the hell is going on? And so that's where markets were at all throughout last year. They were saying the Fed's done here, the Fed's done here, but there really wasn't anything in financial markets that were disruptive or the real economy that was deteriorating to support that idea, right? You can be a rates trader and you could be positioning with Fed funds futures all day long, and you could be saying, yeah, the Fed's going to stop at 3.5, the Fed's going to stop at 4. I'm gonna start buying treasuries here, and then you get burned. But if there's no economic deterioration that's going to warrant the Fed to stop tightening liquidity, and if there's no disruption in financial markets that's going to stop the Fed from tightening liquidity, the Fed won't do it. And what we're experiencing now is actual financial markets disruption that has forced the Fed to shift course, and this is probably the highest we'll go in terms of rates. So that's basically what's happening right now, boiled down.
The Bitcoin conference is coming this May in Miami, and you do not want to miss out. Dan and I will be there. This 3-day event is the ultimate destination for anyone looking to stay ahead of the curve and work in the industry. Industry Day tickets are available for those who want to network with like-minded professionals and learn from the top experts in the field. For those who want the ultimate VIP experience, the Whale Pass is the way to go. With exclusive access to private events and top-level speakers, you'll get the inside scoop on the latest trends and insights in the industry. So why wait? Get your tickets now and join us at the Bitcoin conference in Miami, where the future of finance is being shaped today. Use code BCB104 to get 10% off tickets, and we will see you in Miami. So you think, just a jump shot here, it's your theory then that this will very likely be the peak rates that we're experiencing right now. You don't think that they'll continue to potentially do 25 basis points and then just Band-Aid over everything that breaks on the way? So it kind of accomplishes two goals at once. They can feign that they're fighting inflation while they're also fixing whatever stick and bubblegum shit breaks along the way with special service vehicles that can do whatever they need done.
Yeah, the Fed has a million different acronyms, right? With all of the letters in the alphabet and the fact that, you could have, I'd say probably up to a 5-letter acronym, the Fed has an infinite number of liquidity facilities that it can create. And it's exactly like you said. It's a Band-Aid fix on what's going on. So there are two schools of thought. I'm of the opinion that we are either nearing or at terminal, very much so. The reason being the way that the rates market is pricing this. The rates market isn't pricing what's happening right now as if, well, there's a chance the Fed hikes another full percentage point. The rates market is saying, look, cuts are coming. Cuts are coming. And I don't think cuts are coming. But when the rates market is screaming, back off, please stop raising the policy interest rate, it's not working anymore, we're not budging, then, it's time for the Fed to stop. And for perspective, the reason I'm saying, the rates market is disagreeing with the Fed, each tenor on the U.S. Treasury curve, which is the world's most sort of widely referenced curve, it sort of represents a different expectation, right? The reason people trade these things. The front end, specifically the 2-year yield, the 2-year Treasury note, can be thought of as like forward policy rate expectations. And so when forward policy rate expectations fall below the actual policy rate, right, when 2s fall below the federal funds rate, then that's basically the market saying, yo, we don't want you, no more hikes, please. And it's fallen almost a full percentage point below the federal funds rate. That hasn't had that level of inversion. I don't think has ever happened. And I'm taking, well, actually, never mind. I have the chart in front of me. The last time it inverted by a full percentage point was when the Fed was already cutting in 2007. And then before that, before that in the 70s, right? So this barely ever happens. The rates market is screaming the Fed's done. So that's why I think either the Fed's done here or just for posterity's sake, because it really wouldn't do anything, hike another 25 basis points in May, just for posterity's sake, right? Just to say, like, we've got this, we're not fearful, one more hike, boom. But the reason I'm also thinking that this could be the pause is because the language chosen by Fed speakers in the last FOMC statement, and also what they said today. In the last FOMC statement, they've basically done like a copy and paste because it's all about managing expectations when it comes to U.S. dollar capital markets and in the way that money markets move and flow. They don't want to disrupt them. And one of the ways that they have executed their policy so well is that they always forecast exactly what they're going to do well out in advance. And they try to keep their statements exactly the same as the last time, with just minute changes. And the change in this last one, for the entire last year, they've said the phrase additional increases in the policy rate will be appropriate. Ongoing increases in the policy rate will be appropriate. And they've now changed that. They've removed that entirely and changed it to additional firming of the policy rate will be appropriate, right? Policy firming. So what does the word firming mean? It means pause, right? They're sort of trying to tacitly usher in the pause without explicitly saying it. And also one of the things that they've done, I mentioned they say what they're going to do ahead of time. They totally dropped that. They haven't forecasted at all what they intend to do ahead of time. So they're basically leaving it up to the market and also saying that we're going to go on a case-by-case basis per se, on a day-to-day basis, because we've already reached peak fragility where banks are starting to fail, right? So sirens going off. And so knowing that, the Fed is basically saying, okay, we're ushering in the pause, right? So that's why I think we may get 25 in May, but apart from that, it's done. So terminal is either here or 5.25%.
As I zoom out on kind of this changing outlook on the Fed's hiking trajectory, like, another component is just the fact that in their pursuit to tighten conditions, a bank crisis certainly helps, I guess you could say, in that regard.
Yeah.
And I think that's a good chance for us to go back to that because, as you reflect back on this situation, we go back a couple of years and everyone, especially in Bitcoin, is saying they can't do this and they can't do that. And if they do this, something will break, right? And then pretty much across the board, rates went to places that most of us didn't expect. They went significantly higher than I thought without massive dysfunction. But we have gotten to a point where turns out something did break and a lot of people got caught really offsides. Looks like it may have been mitigated here momentarily. But let's talk high level here about what just happened in the banking sector. And I think maybe even before we kick that off, let's go super basic for someone that wants the 101 of a synopsis of how fiat banking and fractional reserve banking works. And then, we can get into Silvergate, SVB, and Signature and what kind of went down. I know that's a big question, but I think it's worth tackling because I think a lot of people sort of are just pretending like they understand these dynamics when they don't.
100%. Yeah. So to start off with explaining how our banking system works, it basically works on a system of fractional reserves. So what that means is that the main engine of the world economy, the main engine of the United States and also global markets by sort of virtue of what the U.S. is doing, is by this fractional reserve system, and it's by credit creation, which is done through the fractional reserve system. So basically, the way that it works, really boiled down, is if when you go to a bank and you deposit your money, they're lending the overwhelming majority of it out, right? Let's say they lend 70% of it, 80% of it out. And that goes the exact same way for all deposits, right? Because the assumption is that people aren't going to rush to the bank all at once and pull their money out, because with FDIC insurance, right, the Federal Deposit Insurance Corporation insurance, there's this implication that if you've got less than $250,000 in your bank account, you have nothing to worry about. You're fully insured. So there's no reason in the modern era for there to be a bank run. So because of that, banks have the ability to go out and lend out the majority of customers' deposits. And why do they do this? Well, growth, right? We reference it as GDP, but GDP isn't the best measure for growth. Growth is usually measured and it's enabled by credit creation, extending loans to people, right? Not just individuals, but businesses. Capital allocators who want to go out, they want to start businesses, and they want to generate a positive return on their capital. And that's what banks do. They write loans, they extend loans to people through this fractional reserve system. And as a function of those loans outstanding, not all the reserves are held at the bank, which makes these banks particularly fragile when a lot of people come to their window and clamor for their money back, because there are a few things. A, it's really difficult to call in all of those loans that you just wrote right then and there, so you can't meet all deposit requests if all of a sudden all depositors come to your window. And the other things that banks do with these deposits, again, they use the majority of these for investment purposes rather than just holding them there, because banks are businesses too. They purchase securities. So banks do these two things. Their assets are either securities or they're loans that they write. And unfortunately, in the case of these three bank failures that have just occurred, each of them had to do in large part or in small part with the risk associated with these securities that they were investing in. They had massive securities portfolios and very small loan books. And that's not what banks usually do. It's usually the inverse. Usually banks have much larger loan books and much smaller securities portfolios. Because if you're diversifying, you're lending to a construction firm over here. You're lending to a brand new strip mall that's getting built downtown, right? You have this diversification of your loan book, and you also have different duration of those cash flows, right? So you're lending for 2 years over here, you're lending for 10 years over here, and you're getting different streams of cash flows. It's much more diversified, much more safe with different borrowers. But unfortunately, with these three banks that fell, there were different risks associated with the securities that they were holding, and unfortunately, depositors were made very well aware of those risks, and so when they stormed. And they had lost a tremendous amount of money as a result of not properly dealing with those risks on those securities. And when depositors rushed for the exit and said, "I want my money back," well, the banks were forced to sell these securities at a very, very steep loss. And unfortunately, that created a liquidity shortfall, right? If you're taking huge losses on consumer deposits that you're lending out, and consumers ask for their money back, you can't make them whole. 50 cents in the dollar, maybe. 70 cents in the dollar, maybe. And that's basically what happened with all three of these bank failures, in very, very simplified form.
So what we just talked, those two topics we just had are very, very much intertwined, because the securities that they held happened to be U.S. Treasuries. I think they were 10-year bonds that SVB had. And the reason that they got held, or they got caught off sides, is because the Fed had been so aggressively raising rates that they actually, at the market price of these treasuries was down, what was it, like 25% or something in that region. So their depositors found out that they were actually underwater with the amount of cash they actually had on reserve. They had to sell some of those, and then the run of the bank ensued after that. So it's directly because of the Fed's aggressive action that this happened in the first place. So it's an interesting interplay between these two systems that are obviously directly related to each other. And this is part of the reason why many people have the thesis that they can't really keep raising rates at the pace and quantity that they have been, because this is going to continue to happen, especially to small regional banks. As far as larger banks, what is your thought process on what this is going to do to small regional banks or mid-sized regional banks? Because people are going to very likely take any amount of money over that $250,000 amount, and they're going to move it to larger banks. How do you see that interplay with small regional banks playing out here?
Yeah, for sure. So we've actually seen not just from, we've seen the largest single week outflow of deposits from smaller regional banks ever. Small bank deposits fell, I'm looking at my screen here, it was $479 billion. So $479 billion in net outflows from small banks. That's huge. That's bad. And that's a huge headwind for not just banks, but also new loan creation. So we talk about how credit growth goes against what the Fed's trying to do with bringing down inflation. This outflow of deposits from banks, that's also a huge headwind for credit creation. And so because of that, it also makes sense why the Fed's pumping the brakes here, because bank failures, like you said, Dan, they help with the Fed's mandate a little bit. But this shouldn't be good for, this won't be good for regional banks whatsoever, unless they can use any one of these facilities that the Fed has created here. And to some degree, that's actually helping with these outflows, because consumers are seeing, okay, the Fed has intervened, right? The word bailout isn't being used. It's being avoided but like the plague. But essentially, it's like this implicit backstop for all depositors for however much money they have. Because what the Fed has basically done, and so small regional banks, sure, they will take a hit, and some of them will go under, and I'll explain which ones will go under in a minute. But what the Fed has done, it has a standing repo facility, and repo just means repurchase transaction. Basically, all it is if I'm a bank and I want, other banks aren't lending to me, I need money, but for whatever reason, other banks view me as risky, they won't lend to me, I can go to the Fed directly and get money from them. And all I need to do is give them treasuries as collateral, and I can get cash. And usually I get cash at the market value of those treasuries. So let's say I have a whole bunch of the 2-year, and the 2-year right now is trading, the 2-year that I have is trading at 70 cents on the dollar. I go to the Fed, I give them those securities, and then they give me, let's say 65 cents for all my 70-cent treasuries, right? The market price plus a little premium for the risk that they're taking on that I may not be able to pay them back. And then what happens is I repurchase those from them at a later time, right? But that's basically what this is. The Fed has this facility. It's called the discount window. And it's been in place for ages. It's been a permanent facility for a while, and it's basically like an emergency loan facility. But people don't use it. And the reason people don't use it is because there's a stigma attached to it, right? Imagine if I'm a bank and I did what I did. I went and borrowed from the Fed. Well, now everyone knows that I'm distressed, right? I was sort of secretly distressed before, but now everyone knows that, Joe's in dire straits because he just got funding from the Fed. No one wants to deal with him. And then that sort of creates, more risk for that bank. And unfortunately, some banks end up going under as a result of that. So most people just don't use the discount window. But what the Fed has done is it's created this new facility called BTFP, one letter away from buy the fucking dip. And BTFP doesn't stand for buy the fucking puts either. Actually, quite the opposite. The NASDAQ is in a bull market officially. It rose 20% from its bottom, which is absolutely crazy considering the tight financial conditions we're in. But BTFP is called the Bank Term Funding Program, just another silly acronym they made. And basically, it's a variation of this discount window mechanism. Let me pause my Slack notification. It's a variation of this discount window mechanism that allows banks to go to the Fed and post their treasuries as collateral and borrow cash against them. But the difference is, there are two differences. One difference is that they can borrow cash at the full par value that those treasuries mature at, right? So my 75 cent 2-year that I'm going to the Fed with, I'm a distressed bank, I want to borrow, let's use this BTFP facility instead. I get a full dollar for that. So all losses that I've incurred on my treasury holdings, right, which is what caused Silicon Valley Bank to go under, instead of selling them onto the open market, right, which would be a huge boon for yields, it would drive yields through the roof because there'd be all this forced selling of treasuries, which is just a secondary effect. Instead, I can go to the Fed, borrow cash against them. I'm okay. And I can redeem all customer deposits, right? And the term for this facility is 1 year. And the other difference here is that stigma that I mentioned with the discount window, that's not present with BTFP. Nobody knows who
destigmatized. Yeah,
it's totally destigmatized. But also that creates this hidden level of risk in the system, because if banks are distressed and borrowing from the Fed, there's no way of knowing who they are. And so it's sort of because people won't back away from those distressed banks, and they'll continue dealing with them. So that's basically what the Fed's new facility is in a nutshell. And in the interim, banks who don't have treasury or mortgage-backed security collateral to actually go to this facility and take cash out, which some smaller regional banks just don't have treasuries or MBS or a sufficient amount of them, they're screwed, right, for lack of a better term. And there's actually one today, and it's slipping my mind, but it fell from $50 or $35 to I think $22 at the end of the day. Reason being, it's a small regional bank with bad capital ratios, and it doesn't have enough treasuries or MBS to go borrow from this Fed's facility. So basically, it's a fish in a barrel. It's going to get shot. It's going to die. And in the social media era, everyone knows it. So many regional banks, many small banks will go totally belly up. But the BTFP facility does save a lot of these banks, and it is doing its job to some extent.
Dan and myself, Josh, talk a lot on this show about running a Bitcoin node. If you are a serious Bitcoiner and you want to verify, not trust, you will take this step at some point. For our node setups, we run software and hardware from Start9 Labs. This setup enables us to run a reliable and secure Bitcoin node. But then, if we so choose, experiment and graduate way beyond that towards many different areas of sovereign computing. You can download Embassy OS for free and install it on your own hardware, or you can buy one of Start9's plug-and-play devices. We highly recommend these devices. Start9 builds reliable and extremely easy-to-use products backed up with incredible customer support. Run a Bitcoin node, run a Lightning node, run a NOSTR relay. Take control of your photos, messages, passwords, pictures, and data, all on one device. Embassy OS operating system is the distribution platform open source software has been waiting for. Visit start9.com. We only recommend and endorse companies that we believe in, and Swan Bitcoin is a company we believe in. I have been personally using Swan to DCA into Bitcoin since May of 2020, when Bitcoin was the wee price of $9,500. Swan's interface and on-ramp is incredibly simple and user-friendly. With Swan, you can dollar cost average daily, weekly, or monthly, or conduct a smash instant buy whenever you want. Withdrawals to cold storage are completely free and can be totally automated, truly set and forget. Swan wants you to hold your Bitcoin keys, and support is one click or phone call away if you need help during this process. Buying Bitcoin is just the tip of the iceberg. Swan also has a Bitcoin IRA product, business and nonprofit offerings, resources for financial advisors, private services for high net worth clients, and phenomenal educational materials. Visit swan.com for more information. And at swan.com/fire, you can learn about and receive Swan Premium for 1 year.
I'm going to vomit into the mic here for a minute or two because I have a lot of follow-up observations. The first observation is this. If a lot of this went over your head, what we've articulated the last 10 minutes or so is a tremendous amount of centralized fuckery that's going on in the financial system. And when I say that, I don't necessarily say that it's evil or bad, because I think another thing we need to zoom out on is that we don't want the global banking system to implode. I think there are a lot of new Bitcoiners, or maybe ill-informed Bitcoiners, that don't understand, and we say this on Blue Collar Bitcoin a lot, what a full-blown banking sector unwind looks like for society, and it's very ugly. And so it's understandable why they're doing all these tricks, and it makes me think of Carl Lasare, who we talked about before the episode started, and he's constantly barking on Twitter. Folks, they have so many more tricks in the bag. They have so many more spin moves and things that they haven't shown on court yet, but they've done in practice. And we're just seeing this unfold on a week-by-week basis, not on a month-by-month or year basis. This shit is we're seeing new things get invented on Sunday nights, right, and getting rolled out 8 hours later, right? It's crazy. And they have to do this to keep shit intact. Another observation I wanted to make just about banking in general that I think will resonate with a Bitcoiner. The way I kind of perceive a lot of this, and a lot of, truthfully, what's happened in my lifetime, is this stuff is massively centralizing from a financial value transfer perspective for our species, right? You've got tons of bank consolidation. You basically have an environment where if you don't have access to the central bank teat, your money's in significant counterparty risk. So it's a very significant and powerful and troublesome centralizing force in money. And it's another reason why we need to work towards systems and protocols that allow for greater decentralization, because with centralization comes increased risk. The other thing I wanted to say just about the risk that these banks have incurred and the risk that's in the system in general is two things. We're basically getting into an environment where the way I think about it is that, and actually Alf, who I know is your buddy, was saying this on with Preston, was basically that the Fed is essentially treating treasury bonds like cash, but they aren't cash. Like, they are subject to significant duration risk, and that's where inflation is the fly in the ointment. Like, it spoils the whole plan of all these gimmicks, because as inflation was stickier and more prevalent and significant than they expected, this hiking cycle went places, as we said earlier, that nobody expected, and that caused tremendous capital losses that nobody expected. And that all goes back to, in my opinion, it turns out you can't just shut down the global economy for 2 years and face no consequences. Like, this is COVID policy finally coming to roost. And it's inflation that really is the insidious precipitator of all of what we've seen unfold. Do either of you disagree or have any further thoughts on that?
No, I mean, dude, that was a lot. But the thing that really bothers me the most about this, I mean, I understand, that if they don't do these things, the shit just shakes itself apart as it's coming through the atmosphere, But these rule changes midstream, these are the kinds of things that cause people who are paying attention to lose faith, to lose trust, to, in the longer term, I mean, the end game for this, whether it happens in 2 years or 30 years, is the same. I guess, I mean, I would prefer that it happens over a longer period of time. It gives people more time to take cover and protect themselves. But it is akin to just changing the rules of a game midstream. And then guess what? If the new rule doesn't work for you, you're fucked. And if it works for you, great, you win. And this cantillon effect of the rule changes always working for those people, being closer to the money, the spigot for the money printer and all of that stuff, it really destabilizes things on a society, on a social level. And that's why I think you see a lot of these uprisings happen in a lot of, especially smaller countries, because they get a much more acute version of this than we do. I wanted to actually ask you a little bit about commercial real estate, because this is something I've heard people ruminating about, and I think
did you see
it's very likely.
Macro Alf tweeted about it, actually. He had a very cool original tweet about it.
Yeah,
was that today?
It looked identical to your chart.
Yeah,
it seemed,
which was really strange. I didn't know that he had those powers. I was aware. I thought he lived all the way over in Sicilia or wherever, over in Italy, right? He's making pizzas with his grandmama or whatever. I didn't know that he had ESP and he could take a chart that was. I'm joking, but. That was strange.
Of course he does. He's Macro Alf.
Yeah. He knows everything. Hey, why follow the Twitter accounts that make the content? We could just follow Macro Alf. It's so much simpler.
Exactly.
I did not see that tweet.
Helpful thing.
But I wanted to actually just make a quick comparison to what happened in 2008, like the great financial crisis. That was basically commercial real. And I'm sorry, I'm confusing this here for a second. That was residential real estate. People got balloon payments, got over their heads. They didn't understand, or they did understand, but they thought they could refinance at lower rates. They ended up fucked because the market fell apart. They couldn't sell the house without getting completely offsides financially. They couldn't re-up because the interest rates, or they just couldn't qualify for another loan, so they had to just walk away from the house. And then they subsumed the banks because the banks had taken on all these securities that were very exposed to that, and it blew the entire system up. And that's really very similar to what we're seeing in commercial real estate right now. And especially because those loans are generally 5 to 10 years. At the end of that 5 to 10 year period, there's a balloon payment, and generally commercial companies or people will just re-up the loan. Well, right now at 7 to 8% with a balloon payment due, you can't re-up the loan and still be profitable.
Right.
You can't sell it because a lot of these are office space or some, space in a mall that nobody wants. You can't sell it and get out of it. So you're basically left with the option to just either let it rot and walk away from it. So it's it seems to me a very similar situation that residential real estate was in 2008. Commercial real estate seems to be in now. Any thoughts on that or further deliberation?
That is correct. And I'll add some more color. You're right in the fact that like these spaces are really highly specialized. So it's not like you can sell it to somebody and they can retrofit it immediately, right? This is office space. This is space inside of malls. This is these are non-standard places. There are a couple of things, right? In 2008, it was also a function of not just that rates had risen and there were a tremendous amount of variable rate mortgages that were on the market. And so as rates rose, it really decimated a lot of these individuals that were locked into variable rate mortgages when they were very low. As they rose, there was this huge wave of defaults. Lending standards are much better now, right? So people who get loans extended to them, collateral requirements are much better. Background checks are much better. It's not as if people with no income, no job, they can get these loans extended to them at very low variable rates, right? So that's what, like, lending standards are better, but that doesn't take away from the fact that I was looking at CRE, which is a screen on the Bloomberg that basically shows the state of commercial real estate, right? You can see what deals are going on. You can see all the headlines, and you could also see the rate at which people have to borrow. And for 5 to 10 years, it was SOFR for an LTV ratio. I can't remember the LTV ratios, but for example, it was SOFR, which is one of the floating rates that loans get written based off of, plus 600 bips. And SOFR right now is like 4.5%, 5%. So that's 10%.
10%.
Imagine if you were a real estate developer, right? And for example, there's like this really nice burger joint down the road from me, and they have had 3 different attachments to their building, right? It's sort of this strip. There's this burger joint at the end. Those attachments have been vacant for 4 years. And 4 years ago, that property developer probably financed the property at 0%, at or near 0%, right? This thing came around during COVID, roughly around that time. So it was 2-3 years ago, right? And they probably financed it, at 0% plus 250 bips, right? We need credit, the Fed, right? Slam all rates to 0. We need credit creation extended to anyone and everyone. Let's get this thing going. And savvy property developers are like, yeah, that's fantastic. I'm going to lock this in for 5 years at 3%, 4%. Fantastic. And they go and build this burger joint. Now the other 3, none of the other 3 tenants have been filled, right? So it's this empty lot with 3 empty slots and 1 on the end. That's this burger joint. And in 1 year, right? You said 5 to 10 years. In 1 year, their loan matures and they have to re-up the loan, right? They have to roll that thing over. And what's happening? Well, vacancies are totally slashing their revenue, right? Why? Because everyone's staying at home. Why on earth would you set up a gym in one of those vacant slots on that burger joint strip when you could just get a Peloton, right? Or what have you? Why set up office space when you could do remote work, right? And so people are realizing that, this office space is way less utilitarian than I thought it was. I can just do this all on the power of this supercomputer I have in my home. As a result of that, all of this stuff was financed very, very low rates, this huge boom in commercial real estate activity. And now that maturity wall is approaching this year, $93 billion of office debt, $162 billion of total commercial real estate debt. That's burned into my brain because it's terrifying. And then over the next 3 years, it's $347 billion. That's just what's reported of total commercial real estate debt that's maturing. Well, Vacancies are at an all-time high. So they don't have the revenues for it. They're going to have to roll at a 10% rate. You're going to see defaults, right? You're going to see people not re-upping. They're going to leave the property there. Those assets will get reclaimed by the bank and sold off. So you're going to see a fire. You're going to see, for the banks that can stomach it, you're going to see a fire sale of that now vacant commercial real estate property and the assets.
Exactly.
And also, you're going to see banks that can't sell it because they're selling into a market where nobody's buying. They're going to go under too, which what does that do? Tightens lending even more. And that creates sort of this spiral of failures between commercial real estate development and banks.
There was a I found an article, a BNY analyst was saying in 2022, banks, and these are mostly small regional banks that do these types of commercial loans. They do a heavy amount of it.
So small U.S. banks hold 70% of commercial real estate loans. So that is up from 50% in 2008.
Dear God.
So the conjunction here of the bank runs happening to these guys while at the same time they're holding, what is it? I think it's in 2022, they increased their exposure to commercial loans by more than the previous 4 years combined. And since 2006, the strategist said that these commercial loans make up 24% of all bank loans. And the majority of that in these small regional banks. So they're getting this pressure from both ends. And that's going to be just a really interesting thing to see how this all plays out. Dude, what do you think? We're just shorting all these small regional bank stocks right now, right?
I am, yeah. I mean, not financial advice whatsoever. But I'm going back and forth with a few buddies of mine who are also involved in markets. I won't name names. And day after day, it's another regional bank that's absolutely tanking. And it's pretty simple, right? I wouldn't be in options right now. Options will murder you. The implied volatility is not 20% like it should be. It's like 700%. So staying out of options is your friend. But yeah, taking out totally naked shorts in some of these regional bank stocks. Not financial advice, of course, but I have done pretty well.
Yeah, but the thing is like the dark side of that is you could be completely right. This is like a lot of people in 2008 were completely right.
Larry Lepard's
exactly.
a good
Larry
example.
Lepard comes to mind. Like he was completely right. He was shorting, the stuff that was getting murdered. And then the Fed they basically changed the rules mid-game and said, "Oh, you can't short these things anymore. We're stopping this, and go fuck yourself. Now you lost your money. Like you're just fucked." And that's the kind of stuff that just completely ruins trust in a system.
Yeah,
you can be completely right, and yet you're wrong because we changed the rules midstream, and you can no longer actually deploy capital in a meaningful way because you don't know when you're going to be caught off sides just because of a regulatory rule change.
And the kicker is
totally.
And sorry for cutting you off, Dan. The kicker is that financial stability is wicked important. It's extremely important. And as much as I hate the fact that we live in an economy in the United States and worldwide where there is a group of 12 people, 12 unelected elders that set the price of money.
Elders.
Literally.
No, you're right.
Combine their ages.
Tribunal.
Million. Yeah, precisely. This tribunal of dark, shadowy, lurking figures that convene once every month, but sometimes they don't meet on certain months.
Yeah.
And they
all wear dark cloaks.
It's archaic.
They throw dice.
But the reality is that financial stability is important. And so, they're changing the rules to avert Armageddon. But I also hate the fact that they're changing the rules.
Have you guys seen this is on topic, but it's wildly sideways. There's a South Park episode where they show, I think it was a board of Fed governors cutting a chicken's head off and letting its body flop onto a chessboard of like different options for how they're going to make a decision. It's wildly apt for this, how this probably goes. Like, cut the chicken's head off and throw it in the ring and see where it lands, and we'll make a decision.
Guys, here's the deal, too. It's that what's scary is that they may not be as much in control as we think. And this real estate discussion kind of uncovers that. Like, if we're just focusing on liquidity in the banking system, they've shown the ability to backstop and stabilize the Fed, right? But as we look at bigger credit stress out on the periphery, like that's further from that epicenter, right? We're talking about commercial real estate here in particular. They have far less control of that. And the issues are deep, but they're also wide. And it's easy to focus on the narrow center and think, oh, they have that completely under control. But there's a lot of shit that they can't backstop, right? They can't.
On that topic, though, what? Let's just brainstorm here for a second. What could they do? Like, let's say this commercial real estate thing does blow its top off. What do you think, Joe? Like, what would be, you're a Fed governor, you've got to make a decision on how the fuck are we going to keep a lid on this? Are we going to start buying commercial real estate?
Well, I mean, wait, before you go, I mean, the answers in all scenarios, it includes an enormous amount of insertion and a massively growing balance sheet. But I feel like that gets almost exponentially larger the further you get out. Like, the magnitude of what they might have to do from a liquidity insertion perspective is kind of hard to wrap your head around.
So it's all about, in the lead up to 2008, it was exclusively, at least in this instance, like what was fragile before 2008? It was the housing market. That's what exploded. it was a housing market and banks that weren't positioned properly to deal with it, and banks that were taking out, banks in the case of AIG writing credit defaults also. So on these firms and things like that. So in the lead up to 2008, the only thing that was fragile was the housing market. Now, what is fragile? Well, moral hazard has been passed around for 14 years now. We've had zero interest rate policy for the majority of that time. Now everything's fragile. And so the further you get out from the direct epicenter that the Fed already has, they've already shown that they can backstop the banks. They can do that well. They can set up swap. They can enhance their weekly swap lines to daily and reliquify foreign banks that are distressed. They can lower the limits to come into their discount window. They say come on in. They can reliquify banks with ease. But how do you reliquify when businesses start going under?
I know.
Right? How do you actually, you can incentivize credit creation with banks. Like if businesses are really stressed, you can say, yo, all right, I'm going to buy the assets from this bank. Please, here, $1 trillion more reserves, go extend credit. But if the banks don't do that, you don't have many tools. What are you going to do? And in the 14 years now, it's not just prior to 2008 when just the banks were fragile. Now everybody has leveraged 0% interest rates. And now everyone's fragile. And so what is the Fed to do? Well, the Fed will probably, there's been an extreme falling off the cliff in terms of demand for commercial mortgage-backed securities. Mortgage-backed securities obviously spur mortgage creation, right? If there's more demand for mortgage-backed securities, banks are incentivized to go create more loans so they can make more mortgage-backed securities and package them and send them on their way. But the same thing goes with commercial mortgage-backed securities. And so if there's no consumer demand for commercial mortgage-backed securities, and as of right now there isn't, there's only been $40.1 billion in private label commercial mortgage-backed securities that have been created in 2023 thus far. And that's 84.3% lower than it was last year. So consumer demand is nowhere to be found. That means new mortgages will not be extended. That means tighter lending standards for people that want to, for these developers that want to roll. That means the defaults will get worse, and that means that CMBS, sort of shortfall that isn't being made by consumers. That's where the Fed steps in, right? So they step in and they buy these commercial mortgage-backed securities en masse. They buy probably as well these distressed commercial real estate loans that are,
and then we have zombie, strip malls. Now we do now, but like now they are officially zombie strip malls. There's like half of the real estate in the United States is just rotting to pieces because it's just sitting on the balance sheet of the Fed effectively.
Yeah. I mean, that's chances are that is if the Fed were to directly step into commercial real estate, that's in all likelihood what you'd see. You'd see the Fed creating this massive amount of demand for private label commercial mortgage-backed securities. It had been purchasing mortgage-backed and commercial mortgage-backed securities for the last 14 years, but it stopped. And it might need to begin purchasing private label CMBS to fill that demand. So that's what it will do. And it will also buy these distressed commercial real estate loans from banks if this needs to happen, which will obviously, again, moral hazard, all those losses incurred by banks. Hey, you don't need to go belly up. It's fine. And then also the commercial real estate developers themselves can sort of live to die another day. Yeah, no, it's wild. It's wild to think about the possibilities.
I mean, I'm assuming you agree just with it's a very basic idea, but that it is just way harder to control. You outlined how they may do it, but it's a lot harder and more expensive to control these things on the periphery than to say reliquify the banking sector.
It is,
right?
exactly. And it becomes at that point, think of it like in terms of like a nuclear blast. But if, the cleanup crew per se was only able to deal with the epicenter, what about the fallout that spreads around the entire world, right? And that's what the Fed can't control. What can it do? It has three tools. It has interest rate monetary policy, it has the balance sheet, and it has its big YAP. It is forward guidance and Fed speak. Fed speak has almost stopped working, right? Its balance sheet is now expanding again, and it's still raising rates. So what does it do? Its tool set is limited. It becomes very difficult, very expensive. What can it do? Helicopter money. In 2020, they went to the point of mailing people checks. I have no doubt that in the event of a huge deflationary bust where we see something like CRE go up in smoke and even potentially something else, you're probably going to see helicopter money 2.0.
Yeah.
One of the most exciting companies and projects that Josh and myself, Dan, have come across in the last few years is Crowd Health. If you're already familiar with Crowd Health and have interest in checking it out, then use code BLUE for a significant 3-month trial discount. Healthcare is an incredibly confusing, stressful, and cumbersome space to navigate. Crowd Health provides a remarkable and workable alternative to traditional healthcare setups for a fraction of typical premiums. It's essentially the decentralization of healthcare. You can leverage the power of Bitcoin alongside healthcare crowdfunding to put decisions about your health back in your hands. Each member gets access to great healthcare services as well as their own dedicated care advocate that will negotiate your bills and find members the best doctors and hospitals. Go to joincrowdhealth.com to learn more. And if you're interested in the Bitcoin-specific crowdfund, go to joincrowdhealth.com/Bitcoin. BCB listeners can enjoy healthcare freedom with code BLUE to get your first 3 months for a substantial discount at $99 a month. That is code BLUE. Crowd Health is not health insurance, which we feel is a wonderful thing. If you have healthcare needs or concerns, seriously, give Crowd Health a look. The Blue Collar Bitcoin podcast is brought to you by arguably the most legendary company in Bitcoin, CoinKite. They are the producers of the renowned Cold Card, the world's most trusted and secure Bitcoin signing device, built with a plethora of features fit for Bitcoin beginners all the way up to the most advanced of users. This device is a one-stop shop for your Bitcoin custody needs, and something the two of us have trusted for years. CoinKite also manufactures the Block Lock, a gorgeous e-ink digital display art piece sitting in the background of what seems to be every serious Bitcoiner on the planet. Block Lock can be programmed to scroll through key Bitcoin metrics including price, hash rate, next halving date, and much more. Boy, oh boy, will this thing look good in your living room or office. They are also the makers of many other security and fun products for all users, no matter their technical aptitude. Support our show and get a delicious discount on CoinKite products by following our affiliate link on the screen and in the notes, and using code BCB for 5% off the Cold Card.
Yeah. So what that makes me think is that this is very potentially very inflationary for certain sectors of the economy. And all at the same time, the deflationary forces it's fighting simultaneously would probably just be status quo in others, like commercial real estate probably stays relatively status quo while they rescue the shit out of it, while at the same time printing money to stimulate the economy. The problem that I think they would have in that situation is like they're kind of in a rock and a hard place as far as like fighting inflation here is impossible because we need a couple of our tools are dead at this point. The only thing we have left is helicopter money. And I just don't see that working out in a long, that can't last long. You know, whenever that type of stuff that starts to actually happen, that's like Neil Ferguson, when money dies situation.
Yeah, right. And to be
at least the beginning of it.
Right now, like we're not in a situation where helicopter money would be at all warranted. Like we're in a spot, and I somewhat align with Joe Carlosar here in that, the Fed has the ability to, if this credit crunch doesn't extend far beyond banks, which with commercial real estate, the case that I just laid out, and that has been more widely making headlines over the last couple of weeks, that may very well be the case. The Fed probably has the ability to continue keeping rates elevated and just get as much juice out of this as possible before they're forced to move in the other direction. And that's what they're doing. They realize that inflation is still elevated. In any other case, if inflation was at 2% right now, they would have said, this is terminal, we're done. They would have made it clear that policy is easy from henceforth. But because they're facing high inflation, they're forced to put Band-Aids on the car that's breaking down because it just needed to get to the next gas station. So they're putting Band-Aids on the car. There's one guy out the window that's pouring more gas into it because it just got to get to the next gas station. But by the time inflation normalizes, right, all bets are off for what they do in terms of easing.
Let's talk recession here. Let's pull out the R word. How likely is this? How do you see this playing out?
Yes. So the R word. Recession. It's pretty much guaranteed at this point, right? When the Fed is what they're trying to do is they're trying to engineer a slowdown. They're trying to engineer unemployment in order to bring down inflation. That is their policy mandate through and through. That is the Phillips curve by which they live and die, this inverse relationship between inflation and unemployment. Despite there being virtually no correlation between them, even if you lag inflation back and you push it forward, there is virtually, you can't no matter how you manipulate it and massage the numbers, you can't get anything more than like a negative 0.09. That's the best I was able to get when running a regression on many different time series. So there just literally isn't a negative correlation between them anymore. But that's the way the Fed conducts policy. And so it's helpful to realize that that's what the Fed's trying to do. It's trying to slow down the economy. And Fed policy takes 12 to 18 months to actually transmit into the real economy. And you see it begin transmitting into financial markets first. So what we just witnessed with these bank failures, that's a preview of what's to come with the severity of the actual real economy downturn that we'll be experiencing here within the next 6 to 9 months, right? That 12 to 18 month lag before it actually Fed policy changes hit the real economy. First hike was back in March. It was a little bit over a year now. And so, June, September, December timeframe, you're going to start to see the downturn. And just as swiftly as it hit the banking sector, it's probably going to hit the real economy. You're going to start to see unemployment rise materially. And things like that. And you're going to start. We're already starting to see the credit crunch move beyond the financial sector and move into things like commercial real estate. And recession is pretty much guaranteed at this point, right? With the aggressive pace of Fed tightening, right? If you're just to take this to its logical conclusion, bank failures, banks no longer extend credit to people. Businesses are in a fickle situation. They begin laying off employees, right? It's just a recipe for a growth slowdown with what the Fed has done here, and the impact of just total interbank funding freeze, total credit crunch within these banks. That's going to transmit into the real economy relatively shortly here. And from, also from the standpoint of the yield curve, right, it provides a whole lot of signal because it is the most liquid fixed income market in the world. It tells you a lot about expectations because the smartest money is trading this stuff. Well, not the smartest money, I suppose, but the highest amount of very smart money. You can get a lot of signal from it because it's super liquid is what I'm trying to say. And every time the yield curve it inverts, but when it moves back up towards zero, that's when the recession comes. That's when cuts come. And right now we're seeing the yield curve re-steepen pretty substantially back to that zero lower bound. So at this point in time, it's usually when the Fed's already cutting. But like I said, this time it's different because inflation is elevated. And so now instead of cutting, they're leaning out the window and putting gas in the car, right? They're doing all these emergency liquidity facilities. And so it is a strange situation because at this point in time, you'd already see cuts and you'd already see the economic downturn, but it's sort of a delayed fuse, and it's a delayed fuse as a function of, again, this lag that it takes for policy to transmit and the fact that the Fed is sort of propping up all of these different areas that are failing with new liquidity when and where it can in order to keep raising rates. But long and short of it, recession is certainly guaranteed in my view for within the next 6 to 9 months.
Wow. With all of that being said, without this being financial advice, obviously you're not telling people what to buy, how to buy, whatever, but what is some actionable ways people can look to protect themselves through this potential looming recession? And basically how, if you're talking to a middle-class blue-collar guy, and we get this question a lot at the Firehouse, like, what should I do to protect myself? I don't want to lose my ass here. I don't want to be overly exposed to something that's going to just crush me. What is a position besides just like hoarding cash at this point? And I know this is not something we'd ever stick someone to like predict the future for Bitcoin, but how do you think Bitcoin reacts and plays through this whole recession period of time that we're going to see?
Phenomenal questions. First thing I'd say is treasuries. Treasuries are your friend. Front-end treasuries are your friend. A lot of people, they hate the idea of bonds. They hate the notion of bonds. I certainly was one of those people, right? Bonds, you think, dude wearing a corduroy suit with pants that are too long, and so he has to roll them up around the ankles, right? That's what I think of when I hear bonds. I think of mustard-colored tie when I hear bonds, tape in the middle of glasses, right? But you got to realize that, like, everybody wants these things, and in times of crisis, that's what people buy. People hoard bonds, and particularly you want to get...
It's not only that, it's the fact that the rates should predictably start to fall, which should boost the price of these current bonds at the moment.
Precisely, yeah.
So there is good reason to be thinking about that.
Exactly, and so the front end is your friend here. If you got in, thankfully I did a little bit too early, but I really piled into the front end last October when twos were at like 5%. again, you're exactly right. As the yields on those fall, as rates come down, predicting these Fed cuts, which they will, right? Moving into the recession, yields will continue falling on the front end. Then the price obviously appreciates. So you're shielding yourself because obviously it's very deep. It's a very liquid market. The price stands to rise as cuts approach. And also, you're getting 2% on your cash. And so it's a good way of holding. And Alf was right. To give him some credit here. I know he wouldn't give me any credit, but to give him some credit, he was correct in saying that long end treasuries are not cash, right? These 10-year or longer, they're not necessarily cash, but the front end is totally cash, right? 3-month, 2-year, super liquid markets. Holding those into this downturn, that's your friend. That's the not financial advice that I would give people from the yield standpoint, from the price appreciation standpoint, and from the fact that there's a whole lot of liquidity. Frankly, your money is better off there than it is in a bank. And from the standpoint of what Bitcoin's going to do, I wrote a piece back like last June or July called Bitcoin's First Major Recession. It was a 2-part piece, and it went through like Bitcoin's behavior during past Fed hiking cycles. And obviously, this rapid increase in the discount rate, it's bad for risk assets. And Bitcoin was no exception. But when the pause materialized, when the rate pause materialized, Bitcoin soared. Bitcoin did extremely well. Until there was a deflationary bust in 2020 that caused all asset prices to fall, including Bitcoin. And so, what will inevitably force the Fed pivot probably will be that sort of deflationary bust, right? If there's no reason for the Fed to back off, like if the economy is functioning perfectly with 5% rates, the Fed will leave them there. No need to normalize. What will eventually force the Fed pivot is some event that is unforeseen that will cause people to sell everything, right? And so chances are, as the Fed pause materializes, Bitcoin has been rallying, and I think it will continue to be supported here. As the Fed pause, it draws close, and it may already be here. But as the economic situation worsens and cuts eventually come, cuts are not bullish, right? Obviously in the long term, a 0% interest rate is great, but the reason for cuts is not bullish, right? This huge impulse of everyone sell everything, absolute Armageddon, that's not bullish, but that's what forces the Fed to cut rates. And so I think a deflationary impulse is probably what will cause the Fed to cut rates when it does. I don't anticipate that will be soon, but who knows? So Bitcoin will, in all likelihood, chop around, right? It's been very, very supported at this level. It's seen very healthy legs up, rally after rally, and so I think the 20 to 30K range is probably Bitcoin's friend through this period of Fed pause and general uncertainty. Of course, it will get dragged up as other equities do very well. But ultimately, Bitcoin is a great proxy for global liquidity. And so if balance sheets continue expanding on net, like it or hate it, right? Bitcoin is going to do quite well. If central banks around the world, not just in the United States, continue intervening, and then ultimately there is some sort of pivot back to easing or back to just no longer reducing the balance sheet, Bitcoin stands to benefit. But I do think that it all probably ends in a deflationary impulse. So for now, I'd say because of Bitcoin's past performance, the fact that it is a risk asset, the fact that it responds so well to global liquidity, I'll say like 20 to 30K is Bitcoin's friend. I don't foresee any huge risk on catalysts that'll cause it to shoot way beyond that. I think it'll just be supported by this Fed pause where risk assets have rallied historically. And then I think when that deflationary impulse does come, right, Bitcoin, of course, being a good proxy for global liquidity, it won't be safe from that. Where it sells off to, I don't know, but I do know that in terms of catching a falling knife, Bitcoin has a very low liquidity profile, so chances are the buyers of last resort will come in and scoop that up and recover the price back to where it was before, right? So there's going to be tremendous recovery when that deflationary impulse does come, but for the time being, next 3, 6, 9 months, I think it chills out in this area. Very long-winded way of saying that it's going to chop around.
Yeah, I love it.
Sounds good.
One thing I wanted to say to double back for kind of actionable advice, and feel free to agree or disagree. I think for a lot of people, I totally appreciate and agree with what you said about, buying the short end here. But like for a lot of people, that's the time frame we're on isn't even what they're on. They're like, what do I do for the next 15 years with my cash flows, right? Like I don't want to pay any attention. I want to set it and forget it portfolio. I'm not even talking about a year or 2 years. I'm talking way zoomed out. And I think we don't have a simple answer to that, but I'm sure the three of us would agree, expect tremendous volatility as this thing really kind of goes through the birthing pains, as like Pish likes to say, like the contractions are getting closer and the baby's about to come out because the system's like needs to birth something new. There's that much pain. Expect really significant volatility. So be prepared to chill, be prepared to have massive gains and massive losses. Do your homework and DCA into assets with good long-term potential, and don't freak out too much on 6-month, 1-year timeframes, is a message I would deliver to like somebody that's doesn't understand anything that's been said in this episode, which is completely understandable. Would you agree generally with that sentiment?
I'd fully agree.
Joe?
Yes. DCA into assets that have value fundamentally long-term. If your time frame is 15 years, none of this should scare you, right? You know, it's just cycle after cycle. This is what happens. Things get intense. Things get fragile. Eventually, something forces the credit cycle to move back into an upturn, the liquidity cycle to move back into an upturn. So if we're talking 15 years, yes, DCA into assets that have good long-term potential. It includes money market funds. That includes value equities, of course. That includes things like Bitcoin that appreciates in an outsized manner as liquidity expands cycle after cycle. And really, in terms of setting it and forgetting it, money market funds are basically equivalent to cash. DCA into those, DCA into value equities. Try not to be speculative, right? If your time frame is 15 years, right, you can really just DCA for sure.
Well said. Okay, this is a good one to maybe end on. The system is if we're zooming out, the end of a long-term debt cycle, we could say a sovereign debt bubble, a lot of dysfunction, increasing sticks and bubble gum, which we covered on the front half. How does this system, what are we moving into here in our lifetimes? In like our 3 lifetimes, what is this system going to look like in 20 or 30 years? How does it repair itself? It seems so dysfunctional. It seems like every intervention to try to create stability is in the long term creating more instability, and the incentives from the previous cycle get reintroduced in the next, and everything feels like it's rolling downhill if you zoom out. What the fuck is going to happen here? How is the system going to resolve itself? What's your thesis there?
For sure. Yeah. So I think, and I align a lot with Dylan here. Dylan has articulated this tremendously well. Dylan LeClaire. He's a good buddy of mine. Cycle after cycle, the solution is just expanding the balance sheet, and also just basically all of the risks and all of the losses that are assumed by actors within the economy and within financial markets. You eventually get a bailout, right? Whether directly or indirectly, whether it's directly to you or 2 or 3 stops removed from you. The end game is just the Fed becomes the marginal buyer of everything, and they've proven that cycle after cycle. In 2008, it was these awful mortgage-backed securities that nobody wanted to purchase. It was moving in and doing joint buyout deals for Bear Stearns, the J.P. Morgan. It was raising FDIC deposit insurance, which obviously had nothing to do with the Fed, but all these different things basically just putting all of the losses that were meant to be incurred by regular players onto the Fed's balance sheet. And through time, right, that implicit, lifeline just proliferates. The idea that the Fed is going to save us, because if they don't, financial system dries up and the world goes into absolute Armageddon, right, the following day. That's a reality that cycle after cycle, more people are realizing. So they're taking more risk. They're doing things for the virtue of doing them rather than, they're taking out credit for the virtue of it being really, really cheap, rather than for actually trying to provide genuine value for a project that they're passionate in, for a business that they really feel can generate a positive real return. And so this is what happens, right? Cycle after cycle, the Fed always intervenes in one way or another, and through time, the Fed becomes more responsible for the all of liquidity, right? It becomes the marginal buyer of everything. And so if that's the case, right, if the end game is just perpetual debasement, perpetual expansion, perpetual monetary expansion, then you want to hold assets that appreciate in an outsized fashion to that perpetual monetary expansion. And thankfully, we have one. We have one that has an absolute fixed supply, and it's one of the 3 words that's on the big neon sign behind me. It's Bitcoin. It has an absolutely fixed supply, right? And that's never going to change. And I'd encourage people who may be on the fence about that, to go out and read a little bit about what Bitcoin is, why it's so secure, why the rules can't be changed, and then figure out how to buy some of it. I think on a 15, 20, 30-year time horizon, as the money keeps getting debased and there's just more liquidity in existence, Bitcoin has proven time and time again to just be the best sponge, the most porous sponge for global liquidity. And if the case that any one of the three of us have outlined on this episode rings true to you, then Bitcoin should be a substantial portion of your portfolio moving into the next 30, 40, 50 years time frame. Not financial advice, of course.
It's the baby that's coming out, is what he just said, everybody.
Yes.
Crowning. It's gonna hopefully it comes out relatively clean. I mean, no pregnancy is clean. Josh and I each have a couple kids, so we've seen a couple. Have you delivered a baby at work yet, Josh, by the way?
No, but I delivered one of mine, and I wouldn't recommend that to anybody.
Yeah, I haven't delivered. That's
I thought
crazy.
you were going to ask. I thought you were asking Joe if he's delivered a baby. I was like, that's
I was
a
just
strange
curious.
Dan,
I
can't say that I have delivered a baby just yet, but one day.
You will.
Every firefighter paramedic delivers a kid or two. I'm surprised. We have 17 years between the two of us, Josh, and we haven't delivered a baby. I guess we're lucky.
I was on the ambulance. We arrived just after the baby was born, so we took it to the hospital. But no, I didn't actually have hands on that slippery baby as it came shooting out.
Yeah, well, hopefully this Bitcoin one comes out pretty clean, Joe, or reasonably.
We'll see.
So
No C-section,
there's always
hopefully.
Blood, but hopefully it's minimized.
That episiotomy, got to get an extra stitch.
I think that's my new favorite
after
analogy, frankly. I think that is the most creative roundabout Bitcoin analogy I've heard.
I stole it from Pish, who, by the way, is our next guest. Joe, you killed, man. I learned a lot from you.
Yeah,
Super articulate. I just love picking your brain. Very fun discussion. And I limited myself to one beer, so I was able to track with most of it. So that was a benefit. Give our audience a handoff to you and the Bitcoin layer and everything you, Nick, and the team are up to.
Absolutely. Yeah, guys, thanks so much for having me. This was a blast. My evening was going to consist of just staring at more charts, and I've done plenty of that today. So thank you guys for having me on, putting me in last quarter. Hopefully Coach will see this and give me a pat on the back. Give me some ad.
You're a starter for sure.
Oh, that's fantastic. Yeah. Maybe I'll make.
You're coming back on. You're coming back on whether you like it or not.
Okay. Fantastic, guys. Thanks again for having me on. You can find me at Joe Consorti on Twitter. Just the @ that you see on screen or in the description. Just ask at first name, last name. Or you can Google search the Bitcoin layer behind me, subscribe to our newsletter. It's a free newsletter that keeps you in the know about everything going on in markets, right? We boil it down very simply, and we do that for free, right? So if you're looking for free markets analysis, go subscribe to that newsletter or our YouTube channel.
Wonderful.
Beautiful.
Have a great rest of your evening, my friend.
Thanks, Joe.
Likewise.